Have you ever wondered why a professional trader's chart looks almost empty? Compared to a beginner's, it's night and day. Well, today we're going to dig into why. It's not about having more flashy indicators, it's about learning to read the market's real story. Let's dive in. Okay, let's be honest. Does this look a little familiar? A screen just plastered with moving averages, RSI, MACD, you name it. It's a total mess of crossing lines, right? And half the time they're screaming completely contradictory signals at you. This is what we call indicator chaos, and it's exactly where most new traders get stuck. But here's the thing the pros know. All that chaos, it actually hides the market's true narrative. You get so caught up following the rigid rules of your indicators that you're not actually understanding what's driving the price. You're completely missing the plot. So in this first part, we're going to strip all of that clutter away. We're going to move from that confusing chaos to a state of clarity. We're going to start looking at the market through a professional's eyes. You know, this quote from our source material really just hits the nail on the head. A rigid rule-based system is incredibly fragile. Because when market conditions shift, and trust me, they always do, a trader who only knows how to follow indicator signals is left totally lost. They just can't adapt. What's so interesting here is the fundamental shift in mindset. A typical retail approach is totally reactive. You're just waiting for some lagging indicator to flash a signal. But the professional approach, it's proactive. It starts with understanding the market's context to build a hypothesis, and then you look for specific data to either confirm or deny that idea. It's a complete reversal of the entire process. Okay, so how do we start building that professional context? We need a framework, right? A new way to read the market story. And for a lot of pros, that framework is something called auction market theory. At its heart, auction market theory is actually pretty simple. It just says the market is one giant ongoing auction. Its only job, its whole purpose, is to move up to find sellers and move down to find buyers. It's constantly searching for that price level where the most business can get done. And that sweet spot, that's what we call value. Now, to make this crystal clear, let's use a fantastic analogy from this source material. Just for a second, forget about stocks and futures. Instead, I want you to think about a real estate neighborhood. This really makes the whole concept click instantly. So think of the value area as that really desirable part of town where, say, 70% of all the houses are sold. It's the fair price range. The point of control, or POC, that's the single most popular street in that neighborhood, the exact price where the most deals went down. And what about low-volume areas? Well, those are the sketchy parts of town or maybe those super overpriced cul-de-sacs that people just drive through quickly to get somewhere better. The market doesn't like to hang out there. Okay, so great analogy. But how does looking at the market like a neighborhood actually help us make better trading decisions? I mean, what does it really tell us about what might happen next? Well, this is where it gets really powerful. This slide shows the two basic states of any market. First, you've got balance. This looks like a symmetrical bell curve, kind of like a capital D on its side. The story here is simple, more of the same. Price is happy, it's accepted, and it'll probably just chop around inside that value area. But then you have imbalance. This looks more like a stretched out B shape, and this tells you the market is unhappy. It's actively trending on a mission to find a new area of fair value. All right, now that we understand the market's structure, its neighborhood, let's add another layer. We can use specific tools to see where the big institutions, the big money, are actually placing their bets within that structure. A simple moving average, or SMA, treats every single price point equally. But the volume-weighted average price, or VWAP, is way different. It's weighted by volume. So here's the key takeaway. VWAP doesn't just show you the average price. It shows you the average price where the most money has actually changed hands. This is the big boys benchmark. So now we've got our macro view. The volume profile shows us the neighborhood. VWAP shows us where the institutions are playing. But what if we want to zoom all the way in? What if we want to see the real-time fight between buyers and sellers happening right now, inside this very candle? To do that, we need a microscope. And in the world of trading, that microscope is called order flow. It's often visualized using something called a footprint chart, and it literally lets us see the volume of buy and sell orders hitting the market at every single price. Order flow shows you what's hidden inside a normal candlestick. For instance, you can see huge, aggressive selling pressure that should be tanking the price, but it goes nowhere. That's absorption. It means big buyers are just quietly soaking up all the selling. You can also spot when big players get trapped on the wrong side of a move, and that's a huge clue, because they'll be forced to get out, which just adds more fuel to the fire.
But listen, this is probably the most important rule of all. Order flow is not some magic crystal ball. The absolute biggest mistake you can make is just looking for these patterns in the middle of nowhere. It's a confirmation tool. You only use it when the price gets to a key level you already identified, like the edge of the value area or a major VWAP level. Context is everything.
So let's bring this all home. In this final section, we're going to put all these pieces together. We're going to walk through the actual step-by-step process that a professional uses to analyze and trade the market. Okay, here it is, the pro's playbook. It always starts with the big picture, the macro context from your volume profile. Then you form a hypothesis. Is the market balanced and likely to stay in a range, or is it imbalanced and trending? You don't trade randomly. You wait, patiently, for the price to come to your predefined level. And only then do you pull out the microscope, the order flow, to look for that real-time confirmation before you ever think about executing.
You see, the crucial takeaway from all of this is that professional trading is not about fortune-telling. It's about letting go of that need to predict the future. Instead, you focus all your energy on observing and deeply understanding what's happening in the present so you can react with a clear edge based on objective, market-generated data.
So the next time you pull up a chart, I want you to ask yourself one simple question. Forget the indicators, forget all the noise, and just ask, based on its structure, its volume, and its order flow, what is the market telling me right now?